Well, good afternoon, everybody. The clock just flipped over to 12 noon on my computer here, so we're going to go ahead and get started. My name's Rich Llewellyn, and I'm kind of handling things here behind the scenes. If you have any questions, you've got my email, rvl@ksu, if there's anything you have technical difficulties with. If you have questions for the presenters, we'd ask that you put it in the chat, which is you can find it down at the bottom of your Zoom screen. There's an icon there that says chat. You open that up and you can type in a question, and I'll be watching that as well as the speakers, and we'll make sure we get to those. We're going to ask you keep your video off. And so if you could do that, that'd be helpful. And we're going to have the audio also muted, and ask that any questions just go in the chat there for us. We have a couple of speakers today. Dan O'Brien and from K-State, and then Mark Nelson from Kansas Farm Bureau. Before we turn it over to them, just was going to mention the webinar we're also having on Wednesday, which is related to the Ukraine-Russia conflict, and we're having an update on that. And we have a professor from Ukraine who's now in Manhattan, and she'll be presenting some things that are going on, giving a little different perspective with that. Antonina Broyaka is her name. And yeah, she is on. Actually, Antonina, I'm going to make you a co-host. And if you would just maybe turn your video on and let them see you, you can wave at us. She's got quite a bit of understanding of what's going on there. She's in the process of working on her slides and changing all the metric stuff to English stuff. But so we can all understand it here.
Hi, I'm here.
There she is. We can see you. Great.
Yeah.
Appreciate that. She's going to be the speaker along with Dan on Wednesday. And so just thought we'd give you a look at her and let you know that she's here, and she's going to be providing that stuff then. So thanks for getting on, Antonina. Appreciate it. And with that, we're going to go on to Dan and Mark Nelson from Kansas Farm Bureau. He's their economist and handles a lot of their marketing and ag stuff. He's going to go through some things just on pre-harvest marketing plans. This is part of a workshop that Dan and Mark did through the state called Winning the Game. We opened it up to everybody, so even if you weren't at the in-person workshops back in January and February, this is for everybody here. And so Mark's going to start first, and then he'll turn it over to Dan for some stuff on the grain markets too. So Mark, take it away.
All right. Thanks, Rich. Thank you very, very much. Thanks. Good afternoon, everybody. I just want to, I'll start things off. I want to talk a little bit about these workshops. And it was Dan, myself, and Rich was part of that. He doesn't take much credit, but he was definitely in the middle of it and a big help, and was actually presenting down in Southeast Kansas. But we did a series of 12 of these workshops. And really what we tried to do, and I'm going to go ahead and flip my video off and save a little bit of bandwidth too. What we tried to do in these was cover 3 common marketing concepts, right? Pricing targets, incremental sales, and decision dates, all with the goal of creating a marketing plan that we would create and then actually implement. We really spent some time looking at the 15-year seasonal index to kind of help us identify both decision dates and potential maximum price targets. For example, let's see here. Yeah. Here's the 15-year seasonal index. And clearly, May, June, July is typically when that December corn futures is hitting its peak on average versus when we'd be harvesting that crop. And so, anytime we're not making sales, at least in there, and maybe on this before that or even after that, we're leaving some money on the table here a little bit. So we tried to point that out. We looked at what exactly happened because, typically what we said was, on a pre-harvest standpoint, we want to set as a minimum price target our cost of production, right? We don't want to make any sales that are below our cost of production. So that's kind of the easy place. That's your minimum, maybe add a little bit to that. But from there, how do we set up a maximum price target? And so we looked at every one of the last 15 years, 2007 to 2021. we started with that January 1 price and we said, how high did that market go? How high did that December contract go between then and harvest? So not post-harvest, but by harvest. And then we kind of put those in order. And we kind of can so that, 25, 27% of the time, we're going to see a $2 plus rise from that first part of January up through the time that December futures contract maxes out. But also 13% of the time, or 2 out of 15, it didn't hardly move at all from January. So we tried to get people to think about how would we create a plan that could take all of that into effect. If we look at this year in particular, and this is as of Friday, we're a little bit higher again today. Definitely the wheat prices are much higher today. But, we were at 548 on the first trading day of January, and the high came in last Friday at 716, so $1.68. So that would put us here as the 5th highest that we've ever seen. But from that, you kind of start creating a plan. And this is kind of a plan that we might have encouraged people to put together. 6 increments, nothing magical about that, but just spreading those sales out across the year. But we've got increments, we've got pricing targets, again, starting with where we were in January, which is, probably about 50 cents above cost of production, probably more, and then pricing targets, spreading that thing out, again, hitting May, June, July, those times when that contract typically will peak, but also kind of on the edges there, April and August, to just kind of spread those sales out a little bit. This was a fairly proactive plan. I'm not saying that's for everybody, but we use that for the workshop. We were pricing 75% of our APH yield, which in our example was roughly 63% of our expected production. Some folks could go half of that. Some people might go a third. Some people might want to price all. We encourage people to create their own plan. So where would that plan be? Well, in January 4th, we hit 556, so that would have triggered our first sale. February 11, we hit 595. That triggered our next sale. When we did this Zoom like this back on March 4th, that December futures contract was trading above 630, which was our next target. And at that point in time, we said, and we reminded everybody, because one of the pros of a proactive approach is that when the market's going down, these early sales are great. One of the cons is that in a bull market, these sales are often seen as way too early and way too cheap. And that's kind of the situation that some folks are in. And I kind of want to address that a little bit here today. One of the things we can do is, we talked about that, was can I change my plan? Well, obviously, yes, right? If something changes and the market develops a trend that's unexpected, clearly we want to do that. This is the most recent drought monitor. We continue to see that drought in the West move east, and things are a little bit dry. They're getting a lot of rain, say in the Ohio Valley, but boy, the West and definitely Western Kansas is in very, very dry conditions. We're seeing decreasing expectations for South American production, especially on the soybean side. We're continuing to see supply chain issues that are impacting our ability to get crop products that we need in fertilizer. And then obviously the war in Ukraine, which there'll be a whole another webinar really focusing on, is just a black swan event that just is totally upending things. So definitely this is a time to reconsider some of our plans. So we adjust plans. As we do that, basically my 2 cents is this: we want to do 2 things. One, we want to keep it simple. We want to focus on what you can control. And so, just from the overall standpoint, we obviously want to maximize efficiency of our inputs. It's important to note that, crop insurance is going to be asking us to follow best management practices. So you definitely don't want to just throw that stuff out there without enough fertilizer and without enough crop chemicals to do a good job of managing that. We don't want to hoard, but this year more than any other, managing our input inventories are going to be vital. We want to make sure that if we've got the seeds to put out corn, we want to make sure that we've got the right fertility and the right crop products to be able to manage our weeds and things like that. The more debt you have, the more it's important to keep your lenders informed. That's massively important. And I might want to just also point out that last bullet. If you are a diversified farming operation and you do have cattle, boy, we really want to be positioned in that cow herd for success. Again, if you're in the eastern part of the state, not as hurt by drought. If you've got some forages, and again, forages, hay stocks are down. It is getting dry. I'm not saying anybody should be doing that, but if you can retain a few heifers, this is the year to start doing that, right? Y'all know biology. We are continuing to liquidate more and more heifers and slaughter cows. We continue to decrease the size of this cow herd. At some point, this is all going to turn around, as you well know. And while prices are actually above a year ago, really from the fed cattle, from the cow side, from the calf side, we are in a position that in, say, 2 years, 3 years, we could really see cattle prices exploding. And so, that would be a great time to be calving about 10% more cows than you did this past year. So, if you have that opportunity, if there's ways that you can position your operation, that's something to consider. As we adjust our marketing plans, again, two driving things: keep it simple and focus on what you can control. Keep your lenders informed and work closely with your broker or your market consultant if you're using futures or options. Is now a good time to slow down that pre-harvest marketing? Yes, right? Definitely a good time. All we're seeing is this market go up and up, and we really don't know where that top's going to be. We could be approaching it. I don't know. There's still a lot of volatility left. So this definitely is a good time to maybe think about slowing down that pre-harvest marketing. For folks who did early sales, like some of the sales that I've used in my example, we'll talk about that. Maybe it's time to swap out your futures positions and maybe look at forward cash contracts. Important to note, and we had some questions about that, note your local basis, because it's very, very volatile, and we've seen some significant weakness. On the wheat side in particular, a month ago when we did this Zoom call, there were literally some forward cash contracts for wheat that were using the September contract. As far as I could do, I looked back on Friday, continue to look today. Most everybody's, again, now looking at the July contract. So we're kind of flipping back to the traditional new crop contracts, which is good. But that was an indicator that, basis is really getting wonky. Do we want to adjust our pricing targets? Most clearly, yes. Let me give you an example. Back in March 4th, we had already implemented 2 of our pricing increments, right? We sold January 4th at $5.56. We did it again in $5.95 in February. That was fully 2 months ahead of where our time frame was. We're hitting price targets ahead of our date times. So, one of the things you can do is just roll everything forward. And that's what we chose to do. That 630 target, we said, hey, let's shoot that up and make it 670 for that third increment. And we just added one there in the bottom. So where does that put us? Now, as of last Friday, we would have hit that next pricing target of 670 on March 23rd. So that would put us a half priced on our forward, on our marketing plan. So we're really making big progress. And again, given that upward trajectory, would definitely suggest rolling that forward again. And so, maybe those adjustments would make it look like this. We'd be targeting 750 futures or selling our wheat at that fourth increment by June 15th. Let's give it a little bit more time here. 790 and then 830. So we're adding. That's one option you could look at, is just continuing to roll those pricing targets forward. But again, I sure would recommend have a written plan. Early sales are often seen as too cheap. Man, most definitely. Garden City crop, here's new crop basis. The 5-year average is 2 cents under. And so, again, in our situation, back in January 4, initial corn future sales, we sold at 5.56 using a 2 cent basis and hedge cost of, say, a penny. That would give you a net hedge price of $5.53, which at that time was 53 cents better than any estimate of expected costs that we had heard. One of the things we did in these workshops is we looked at Kansas Farm Management Association data. We looked at KSU budgets for this coming year. And then we just talked to the members or the farmers that were there. And we said, what do you think your costs are going to be? The highest we ever heard was $5. And so, a person should feel good about that price. At that time, January 4th, that was a good pricing decision. And I think, as a marketer, you need to keep that in mind. Don't have seller's remorse. That was a good decision. Now, 2020 hindsight, obviously we could have waited. But at that time, that was a good marketing decision. So where are we? If we were implementing that plan that I outlined, we sold in January 4th, February 11th, and March 23rd at the prices on that table, 556, 595, and 672. Every one of those positions are currently underwater, right? Prices have continued to go higher. I've got the estimated margins on there also. So at this point in time, this marketing plan would be incurring just under $33,000 in margin calls. That's significant. But where are we at? Okay, our average hedge price is 608. So on average, we're $1.08 behind. But over $5 cost of production, we're $1.08 over our cost of production. So again, these were all profitable hedges. So I think we need to keep that in mind and remember why we priced. Those were good decisions. But yes, we're behind on the margin side, but we're ahead on the cash side. And looking around the state, I think we had a question in March. What if I sold some wheat back in November, October? Same kind of thing. If I sold November 5th using, say, a 13-cent basis, futures were 776. I would have had an expected net hedge price of 762. Again, I'd argue that was a good decision. There's no reason to not make that pricing decision. That's profitable. But where are all these decisions? Well, 556, again, we're $1.60 under on the corn. On the wheat, that position is now $3.34 underwater. So in our margin, we're really behind. So what do? Well, again, kind of following that premise of let's stay the course. Let's keep it simple. One thing you can do is just stay the course. Hang on to that and ride that thing out and see if prices go down. I think as you listen to Dan's outlook, he's fairly bullish. As I look at where I think prices are going to go, we're probably in for some fairly high sustained prices here over the next year to 2 years. So one other thing we could look at is swapping out futures positions for forward contracts. How might that look? Well, on the corn side, and again, I'm going to go back to Friday. Today we haven't closed, so I'm just going to work off of Friday. Again, I know where the corn futures are higher and definitely wheat is higher, but we could have got out of that position at 716. So I would have locked in a loss of $1.60 on the futures, throw in another penny for my hedge cost. So I could forward contract though in Garden City at 746 last Friday. My net position then would be $5.85, which is actually above my expected price back then when I would have done it in January. Why? Because basis is 30 cents stronger right now. So actually we've seen basis get stronger out there in Western Kansas. What about Salina wheat? We're 334 under. We could have sold July wheat futures at 11.10. We'd lose 335 when we throw in the hedge costs. We could have forward contracted in Salina at 10.80. That puts us in a net position of 745 because basis is weaker, 30 cent weaker basis. Now that's both, probably bigger operations. And again, out there in Western Kansas, where we have a very strong basis on corn and a terminal elevator there in Salina. What about other places? Place center corn. 556, if we'd have done that back in January, we'd been looking at maybe a 33 cent basis. Again, we'd be having an expected net hedge of 522. I'd argue in north central Kansas for a lot of folks, expected cost of production at that time was 475. You're 50 cents better. That's a good decision. Colby wheat back in November 5th, 776, expected basis of a 39 cents under, throw in a hedge cost of a penny, you're at 736. Again, I'd argue that was a good decision given what you knew back then. Where are those two things? Again, we're $3.34 behind on that wheat hedge. We're $1.60 behind on the corn. Where are we on trying to swap that out? Get out of your futures position. You lose $1.60 futures plus your hedge costs. You could forward contract at 666. You'd be netting out at 505. Why? Because basis is much weaker, 50 cents now as opposed to 33 cents under. So not as good a situation. I still argue you could swap out today and be done with that thing if you wanted, and you still be making a profit. Colby wheat, even worse. We have an 85 cent basis out there, so that's really hurting us. We swap that thing out now. Your net position is 690. Again, the key is you got to go back and say, am I covering my cost of production? and then listen to the outlook, make your assessments of what price potential is. But if you're really concerned about, hey, I don't want to incur any more margin calls, I believe upside is much higher, you may want to be swapping these things out. I sure would hate to see people get out of their total position. Even though we have that weak basis and you're really kind of taking a bite on that wheat situation. Here's those 4 situations I threw out there. Southwest Kansas, we're seeing actually basis is stronger than what you might have thought. So it's a great time to swap that thing out. Central Kansas corn, Central Kansas wheat, Northwest Kansas wheat, we're seeing much weaker basis. One of the things I think we need to look at there, and again, as you listen to Dan's outlook, kind of think about, pull out kind of his thoughts on this. Is it grain stocks that are driving this volatility and weakness? Well, probably not the basis weakness, I don't think. Tight grain stocks, you think would give us stronger basis. Price uncertainty and volatility, most definitely. I think there's also, just like for the farmer who hedged in November and your $3.34 in margin calls, or that January 4th hedge that we put on with our corn and you're $1.61 behind, elevators that didn't, forward contracted, they're in the same boat. And there may be very little desire by elevators to add to those current positions. And so we're probably seeing a much wider basis partially because of that. Last thing I want to leave you with is just a quick scatter chart. This is just Central Kansas wheat last week of June. And it's just a scatter chart of basis versus the U.S. average price. And I guess basically that's a good demonstration that there is no association, right? That's a shotgun. And so the fact that, say, we're seeing 85-cent weaker basis right now on forward contracts in Colby, we could very easily see an 85-cent basis at harvest. There's no real reason, I don't think, to think that as we get come at harvest, both feed grains and wheat, that it could get stronger. Basis is the market determined relationship to futures prices. And so, I think we need to be looking at these and making these decisions. But if we're feeling like, I kind of want to get off of this thing, that might be the one option we want to do is swap that out, go ahead and bite the bullet, forward contract, lock in a profit, not as good as you would have liked. But again, that way, at least you can come back and focus on managing your farm operation and not worry about margin calls. With that, I'm going to turn the rest of the time over here to Dan. Thank you all very much, and we'll take a look at what some of the questions are. Let's see.
Well, we're talking about dynamic grain markets this year in our session today, and situation and strategies. We kind of started out with some of the strategies, and I think that the situations are going to feed into the strategies. Okay, so in terms of focus, we do want to talk about these situations, the key supply-demand issues that we're dealing with, and really across the board for all these commodities on a world basis. We have tight stocks, and so that has been one of the issues, our key issue, that has made the Ukraine-Russia conflict such a point of concern in the markets, and that we came into this already being pretty tight. And then so when we talk on Wednesday about the likelihood of being able to pull supplies out of Ukraine, out of that part of the world, Ukraine or for Russia, that's an important point in looking at how grain markets may function this year and where prices may go. So we do want to look at corn, sorghum, wheat, and soybeans today in particular. Did want to bring up the U.S. Drought Monitor Map. It's interesting to see, yes, in the Western Corn Belt, that we're certainly dry, and well, from a Kansas point of view, the western half to 2/3 of the state, particularly the southwest corner, really showing a lot of stress. I like to look at this map also, predicted soil moisture anomaly, that yes, all the areas we just saw on the drought monitor map are certainly showing drought, but you also see all of Iowa and on into southern Minnesota, southern Wisconsin, northern Illinois, also having problems. Missouri also had issues. So that'll be great for planting. We'll be able to get the crops in, but there was an article that came out within the last week or so talking about how the persistence of the La Nina weather pattern that we're in doesn't have to stay all summer to put us at risk to a dry situation. It just has to stay around long enough for us to start worrying about, and heaven forbid, seeing high pressure ridges form during the month of June, et cetera, that would block moisture coming into this part of the world. Now, nobody is wishing for that, particularly this year, but that's an issue that to look at as we look at the high prices we have. On the one hand, a lot of it's spurred by these international concerns, but also by dry conditions we've got here right in North America. Would also say that in terms of a long-term perspective on dry conditions, that again you see to the north of us, parts of Iowa again, and that this is about the third year in a row that same part of Iowa has had issues. It's concerning, but also you can see that from this longer term perspective, that coming into parts of northwest Kansas as well as southwest Kansas, even on into parts of eastern Kansas, we're pretty dry, and we see that affects, of course, the risk of wildfires around the area. That's a local concern for us, but it also affects our crop production potential for sure. From a world point of view, just very interesting to see how much of North America on into Canada, down into Mexico, are dealing with dry conditions. And again, it's a La Nina year. We are seeing parts of South America, Argentina, Brazil, some other countries, Paraguay, dealing with droughts in parts of their key production areas. You head up into Europe, parts of France, parts of Spain, also dry. I see some dryness into Russia, on into that general Asian area, as well as Morocco, North Africa. And although we're not hearing a lot of reports of problems yet in terms of affecting crop production, still they're developing some dryness in Western Australia. And if anything, they're at times they're more concerned about too much wetness in these weather patterns. And we don't have a circle around or an indicator looking at Asia and China in particular, but their problem in recent years has been too much moisture at times. So we have issues of either too little or too much moisture affecting world grain markets, which basically we translate that it's affecting world food markets. So anticipating 2022 U.S. crop acres, we just had a March 31st a prospective plantings report, and the results were a surprise to the market for some of these commodities. Wheat projected at 47.4 million acres, up 1.3%. That really wasn't the surprise with high prices, particularly for spring wheat. There's hope that USDA was planning anyway on spring wheat acres to be up. Soybeans were the surprise on the rising side, 91 million acres projected to be planted coming out of that USDA report, up over 4% from 87.2 million. And those acres largely came from corn. Corn at 89.5 million acres, down about 4% from 93 million last year. And this was a surprise to the market. Prior to that report, they were expecting sideways, pretty much a sideways situation, a little bit lower on corn, soybeans up a little bit. And this really changed the dynamics and has forced a re-examination of what we anticipate for productions this year and how tight or how plentiful stocks will be. Sorghum down 15%. A lot of that's in Kansas and in Texas, down to 6.2 million acres, down from 7.3 a year ago. Cotton up. In fact, aside from sorghum, cotton was up, projected to be 12.2 million acres, up 9% from 11.2 a year ago. And since that time, if you look at these corn futures, it's been moving up at a greater than 45% angle to the high side. We'll take a look at that. So you have to ask, will recent corn price strength change farmers' planting intentions? The corollary to that is, can they get the fertilizer and the seed to take advantage of some of the higher prices now on new crop that they're seeing for corn? Let's take a look at corn and sorghum markets. By the way, I gave you a number of slides. I'm not going to show each one of them in the interest of time, but you've got them all there to reference. So here you see the chart. So 89.5 million acres is not a catastrophe necessarily, because we've been there 2018, 2019, not far from that, 2021, but we're certainly down from where we were in 2020 we were at 90.7, but we're certainly down from the high 2021 and another high back in 2016. And so you bring that into play, and I'm kind of prefacing this as saying, since the USDA's Outlook Conference adjusting now for these acres, I think it behooves us to come back in and look and see how the expectations have changed. So we have tightening stocks to use. The USDA has been dogged in their persistence in holding on to 181 bushels per acre as a yield. And you look at the drought monitor map, the lack of fertilizer, that seems to be pretty strong assumptions. Some might even say heroic. So I'm going to go with a 177 bushels per acre, what we had last year. And some would say even that is high, but let's go with that. They give us production of about 14.5 billion bushels. With these low acres, even if we had the 181, we'd be at 14.8. And those of you that are corn market watchers are noticing something immediately. That's below 15 billion bushels. So if we get below 15 billion bushels, we're tending to tighten up stocks to use. Ending stocks, if we had 177 bushels per acre, the same yields we had last year, we'd be basically at about 1.1 billion bushels. If we get the 181, we get tremendous weather through the summer. We're about 1.4, just a little bit less than we have now in this marketing year. Stocks to use, well below 10%, 7.4%. At the latest WASDE report for this current marketing year, ending August 31st, 9.5%. And so if this comes about with these acres, unless there are more acres bought in the market, unless we get tremendous yields, you're setting up for stocks to use well below 10%. I look at stocks to use price relationships, you're at $7 plus cash corn price. So Mark, your price goals that you were talking about earlier aren't far off of this. In fact, the numbers are actually about 725, as you'll see later. At 181 bushels, we're sort of on that precipice. If we're close to 1.4 billion bushels carry out, we're probably about $1 lower at $6. So we're just at the inflection of where that market turns. The futures, current USDA forecasts, out of last WASDE report in this marketing year, the 21-22 year ending August 31st, $5.80 a bushel US average price. Of course, front end of that marketing year had some lot lower prices than where they're at now. When you look at what the market is saying right at this time, it's probably closer to 609. So 580, 609, you can argue back and forth. Out of that, that said, coming out of the Ag Outlook Conference, the USDA was projecting a very conservative price, $5. This is before Ukraine, before other issues came in. At least as I look at the futures using current healthy basis levels and where the futures are at, it looks to me like they're projecting something closer to 668, 670, something like that in terms of where prices would go next year. So I think an issue for us to think on, or a set of issues, because you've got this happening in all these major commodities, is that the futures are coming in and projecting prices a lot higher than what we're conservatively projecting in the cash market. So basis relationships are going to be critical, but I guess we'll see where all this goes. I did want to show you the daily May corn futures. And again, we've been pretty much moving sideways for about the last 2 or 3 weeks. Key date in all of this was March the 7th. That's when we ran pretty high up in the grain markets, came back off of that on March the 8th. But since then, you can argue that basically we're trading sideways in the lead contracts, but not in this contract. These corn futures, following after that March 31st report, strong move higher. 716, they were trading about 650, 640, thereabouts, 660. We've gained. And those numbers, to me, it looks like it's reflective of a market concerned about having adequate supplies that would rather not have 14.5 billion bushels of production, would rather have 15 plus. So it looks like we're aggressive in corn and trying to bid for acres. You look at November soybeans, they're pretty much going sideways. So corn's making a bid. I did want to look at basis levels again. Salina basis for corn, you can see the weakness that we'd had in about weeks 11 and 12 of this marketing year, getting down to 50 under, then gaining back some of that weakness. Mark had mentioned Garden City. Garden City's demand center for corn with feedlots, ethanol plants, livestock feeders, all bidding for grain. We never saw the weakness out there. In that area, that demand center for Kansas, demand center for the country, for corn, we didn't fall off a bit. We just kept bidding. So 50 over, and Mark, on those marketing plans, so much depends on what part of the country we're in, but we've got strength in basis in some of these demand centers for corn in particular. I just wanted to put this up there to show you where we're at export wise. So this last week, you had shipments of about 64 million bushels for the week ending March 31st. We need a pace of about 53 to meet the USDA's projection. So you bring all this together, you look at total sales in this current marketing year relative to how many weeks we are in. So we're about 86% of the way to 2.5 billion. We're about 58% of the way to the through the marketing year. We're even seeing strong sales coming into that next marketing year. We see it in the ag news. China's come in, bought grain and old crop, and new crop came in this morning, bought more old crop grain, corn in particular, as I understand it. So pretty strong situation in the corn market. Bullishness, you can only call it bullishness when you look at this type of movement. And you can see now the weekly pace of exports starting to pick up. Strongest year we've had on record was last year, 2021. And now it looks like with what we're starting to see that this current marketing year, as we head into the last 22 weeks or so, 22 weeks, that's right, could very well rival or beat what we had last year for exports. And that just tightens up stocks and gives us price strength in corn. I'm skipping over a slide where I put together calculations for alternative corn supply demand scenarios, projecting out into 2022-23. And these are mine. They're not USDA's, so I don't want to besmirch USDA. But at 181 bushels an acre, it looks like you build a case that we've got just about the same stocks to use, probably about just a little bit higher prices, $6. But I've already tossed my hat in the ring, thinking that 181 is pretty high compared to given what we're dealing with in both fertilizer and some dry conditions. So if we recede to 7.4% stocks to use, 725, and then you can see what happens if we get tighter than that, 175. Really, 175 isn't a bad yield in a lot of years, and what you can see that you're shooting to a pretty high price. The highest price we'd seen on record prior to this was back in the 2012-13 marketing year. We got to 689. So I don't want to be over boisterous in talking about this, but we have that type of risk in the corn market this year. We'll talk more about international issues on Wednesday. I just did want to point out that from a world minus China corn supply demand perspective, we're pretty tight. This is before you start adjusting for, well, there are some adjustments that the USDA has already made for old crop corn coming out of Ukraine. And you see some of that here. In essence, we're sitting at about a 9-year low for world less China ending stocks, stocks to use at about 10.5%. So we're not plentiful to begin with. Well, excuse me, last year was the 9-year low, and we're projected with a good Brazilian corn crop, if it comes through, to go a little higher. Did want to mention grain sorghum. USDA projecting 585 for current marketing year. It looks like the futures with basis levels as they are about 651. And for the new crop year, again, they were very conservative, 490. And it looks like for grain sorghum, we're closer to 725 in terms of what the futures are saying. Strong basis for sorghum. And so there's been a lot made about the decline in sorghum acres. The issue was that we had a tremendous year of acreage last year, 7.3 million. We're down to 6.2, and that's the second highest since 2017. So we still have a good number of grain sorghum acres, but we had a whole lot of grain sorghum acres a year ago. And again, we're limited on time, but we've been having a string of about 3 or 4 weeks in a row of pretty good grain sorghum exports. So we're probably on pace right now for grain sorghum exports to meet the USDA's projection and probably exceed it. And you can see on the graphic here. Okay, let's talk about wheat markets. There wasn't as many fireworks with regard to the wheat planted acreage numbers, but you can see we reached a low in the US in 2020, and we've been trending a little bit higher coming out of that. So compared to 2020, we're about 2.9 million planted acres of all wheat higher than we were. And about 1.9 million acres projected to be harvested by my numbers anyway. Wheat stocks are generally okay. So we're going to look at a situation that I'll just put all this out, that it doesn't look like we in the US are very tight in terms of stocks, yet the prices are exploding. So in my own thinking, we have sort of okay, if not anemic exports. We're concerned about drought, but we're not, going down to 18 or 20% stocks to use on wheat. So the U.S. wheat market seems to very much be affected by the international wheat market concerns. And although we're not exporting a lot of wheat right now, we're priced just enough higher than these other countries that again, we're not really competitive with them at this point in time. However, if we started to drop off our price, then that would probably change. And so I think I don't want to use the overused phrase of that we're the supplier of last resort, but we're one of the tail end suppliers at this time. We're sort of the buffer stock at this point in the world wheat market in the US. But look at these prices. Projected current prices in this marketing year, $760 by the USDA. The current price in the futures as we wind into the end of this marketing year, probably closer to $795. So not too far off, but I was hesitant to even show this to you. When you look at the USDA's projection, their outlook conference, $680 for next year. The futures have a number north of 10 at 1117. And that number, if you use current basis and go forward, it's above 12. So we have a real difference of opinion that'll have to be reconciled between what we think will happen in the wheat markets, in the cash wheat markets, and what the futures are saying in their worry going forward. You can see for daily hard red winter wheat, the May futures for Kansas hard red winter wheat futures, pardon me, Friday's close 11.06 3/4. We'd ran up to 13 when in the midst of our concerns earlier on, again about March the 7th, and came down to below 10, and that's a pretty wide range. If anything, you can probably say, well, it's kind of it might be range bound, but it's a downtrend range, so it is what it is, I guess. But still, it's way above $10, and you can see all the major run that's happened. Basis, Mark had mentioned again in Mark had mentioned earlier in March the 4th, when we held one of these meetings online, we had seen a major drop in wheat basis. We've seen some of that come back. Again, these same players that stepped out of that market, that weren't giving bids at that time, millers, other exporters, etc. Again, they've got to do business. So it doesn't, I guess, in hindsight, now I can speak confidently. Well, in hindsight, I knew it'd come back. Well, now wait a minute. You don't know that for sure, but it doesn't surprise me that basis has recovered some, because we still have to use wheat, even if at that time they held off in bidding on those contracts. Just wanted to show you what the anemic performance of wheat has really kind of encapsulated here. We've had a lot of weeks of 11, 12, 13 million bushels of shipment. The USDA's projections have been 20, 25, now 27 million bushels needed to meet their 800 million bushel export goal for hard red. We had a particularly rough week the last report. A lot of times we're at 3 and 4 million bushels. We're down to 1.6. So we have seen wheat, all U.S. wheat exports, and the hard red ones pretty much parrot this. We're trending to the low end of what we've seen in recent times on U.S. wheat exports. A lot of that's the high prices. Again, at these prices, people buy at need when they have to, and they're not just buying anything extra. So, and I think that's what's showing up here. So on the one hand, we talked the negatives of the wheat market, and here's on the other, here's the but it's still, we have to be cognizant of this world situation. So if you look at the different scenarios that we'd have, really kind of looking at how wheat yields would work out on the high side versus the low side. Probably the safest thing to do is think that, well, for 760 this year, you'd probably expect 765 next year with just a little bit more production, because that's what the acres are pretty much saying. But if we would have a great year wheat wise, and I would wonder about that given how dry we are in these hard red winter wheat areas, then yeah, we grow stocks to 40% plus, we're down to 650. But there's the possibility of tough Western Corn Belt wheat production for hard red. You're dry in the white wheat areas. You're dry. You've got some dryness still lingering in parts of the hard red spring. We take U.S. ending stocks to use down to 25.9%. And note, we were last down there at 2013-14. Given inflation, et cetera, and you look at how the price relationships work out, $9 cash wheat, record high. So we're balancing the risk of this happening, and it'll play out in the next 90 to 120 days. Okay, I do want to again look at the world minus China perspective on wheat, and we're tight. We were tight before Ukraine situation came into play, and the Ukraine situation. And Tony, I really look forward to what you're going to have to say with regard to just the logistics, the ability to harvest, the ability to move grain out of there through the Black Sea, all these other challenges. We take in that next marketing year, take Ukraine out of this, and they're a sizable exporter, then these ending stocks figures get exacerbated. We're already sitting at a 14-year low in world minus China percent stocks to use, and that's a worry for food planters in the world. Soybeans, we got a few minutes left to talk about that. It's no surprise why this happened. When we were looking at, as Greg Ibendahl, our colleague, has talked about, the sky high fertilizer prices in at $1,400 a ton. Other fertilizer products moving to such also other high levels. So we're seeing the initial response is that people would like to plant corn, like to plant grain, sorghum, etc., but they're moving off into these other crops or other oil seeds that don't take as much fertilizer. And so there you go, from 87.2 million planted acres last year to a projection of about 91 million for this year. So you bring all this into play, and you paint quite a picture, really, for where stocks to use go for soybeans. Just put them all out there. You can see a situation where we had a healthy crop last year, 4.435 billion bushels at 51.4 bushels per acre. You take these higher acres, adjust back for what's not harvested out of that, you're looking at about a 4.6 billion bushel situation. Ending stocks 381 was 260 last year. Stocks to use 8.4%. It was about 5.9 a year ago. And a lot of people will look at this price number with skepticism. But 8.4% stocks to use at 11.25 and 13.25 at 5.85, not too far off of what you'd expect in terms of price relationships. Yet, when you look at the USDA's projection for this current marketing year, 13.25, 13.17, just pretty close. New crop soybeans were projected by the USDA in their outlook conference 12.75, and really the futures they're talking about something about $1, about 13.73, about $1 higher than what the USDA was projecting. And if you remember that chart for corn, corn chart shooting up more than a 45% angle to the high side, soybeans pretty much moving sideways. So compare these two major competitors for acres in the U.S. Corn Belt, and it looks like corn's making a move. Soybeans are what they are. Basis, you can see a very similar basis pattern. Soybeans, it's Salina. We have had pretty strong exports for soybeans. Last week, about 30.6 million bushels. And again, this is the time when generally you see South America being strong. And need a pace about 21 million to get this year. But note, in the current marketing year, we're about 99% of the way bought forward to the USDA's projection. We're only about 58% of the way through the marketing year. But look at that bottom line. We've already bought ahead. Others have already bought ahead 311 million bushels of the US soybeans for the next marketing year. We're about 14.5% of the way the USDA's projection, 2.15 billion, and we haven't even started the marketing year yet. So pretty aggressive. And you can see the pace for soybeans, strong, decent pace, not as much as last year, not yet. I did want to point out that we'll be talking about sunflowers on Wednesday, but the lack of sunflowers coming out of Ukraine this year has affected the soybean oil export market out of the U.S. That number is not a misprint. We had 50.2 million, 50.2 thousand metric tons shipped in 1 week, week of March 31st. We need about 5.2 5.9 thousand metric tons to meet the USDA's projection. So you can see, come into the bottom side of this, we're halfway through that marketing year. We're already about 98% of the way either shipped or bought ahead. So pretty strong on the soybean side, affecting crush margins and moving forward. Projections for soybeans. You've got, again, you've got the 51.5 bushel per acre scenario, the 50.5 and 49.5. And again, as you look at how that affects ending stocks to use, you can see the gradient or the digression moving, the impact of those moving lower, and the difference. So on a two bushel difference, you've got about a 3 1/4 difference per bushel impact on prices. So we haven't planted this crop yet. We'll be watching closely to see what happens, and in the pre-harvest time frame, it's bushels that drive the rest of the supply-demand balances. And just wanted to show you on soybeans, we're at 10-year lows for stocks to use, 8-year lows for quantities of soybean stocks. So again, for every one of these crops, we're tight. We were tight before anything happened in Ukraine. We were tight before a drought came in this year and affected us, and now we're on the precipice of a really tight supply-demand marketing year with high prices. Okay. Very good. Well, my goal was to be done by 1, so that if anybody wants to stay around and discuss things, that we could. Are there any questions that I can try to address? And Mark, I'd invite you in on this too. Oh, Louise, you'd asked why U.S. exports are weak. They're weak for wheat, and I think it's our competitive position. A lot of it has to do with the logistics of shipping from the United States to Morocco, as opposed to shipping from the Black Sea region or from Europe to there, and also the U.S. dollar. Even though we have our own problems in our currency and finances, still our currency is holding up pretty well relative to the currencies of some of these other nations. So that'd be my response to that. Another question from Louise, is Russia able to export wheat because of sanctions? Mark, I think you've answered that already. Thank you. So I might just go back then, Mark, in terms of that marketing strategies. I think that, so when's the risk? When, if the markets do come down, when would they come down? Well, you and I in these workshops have talked about seasonality. So what combination of situations could come about that could start markets moving lower into harvest? Well, if we're successful in planting, we get moisture, the market decides to be less worried about getting sizable crops in this year. And so when does that happen? Well, we plant a lot of these crops in May, some in early June. We'll move into June, July, and just as that marketing plan you laid out there showed, that we're basically looking at strategies to market, to take advantage of seasonality through July and maybe August. Sometimes by August, it's too late. So as we said here in early April, the time of probably the most opportunity is running from the rest of April into May, June, maybe July. It's just really a key time for any forward pricing of grain. Terry Riley asked a question. Domestic soybean oil market firming, will that curtail exports? Well, in a normal situation, when we had a lot of competitive oil seeds out there to step in and take advantage of a price situation, yeah, it'd be a competitive market. But we've had I think a situation that hasn't rectified itself yet in terms of palm oil being tight over in Indonesia. Of course, sunflower production, strong majority of that coming out of Ukraine in particular. So normally, yeah, you'd see some curtailment, but this is a very inelastic situation. There just aren't a lot of competitors. Inelastic in terms of demand, because where else are they going to go? So people will buy under duress, but you're talking about food usage, Terry, and I still think things hold up pretty well.
Dan, did you see the question from Wes Beal? I have not done any research.
I missed that. Okay.
And again, I think that's where Rich was at. And is Brian on the call? Does he have any insights on where the and maybe he's answering? Oh yeah, no.
Brian's not on here. I actually checked to see if he was, but he's not. Brian Brigham is one of the professors in our department and works quite a bit with farm cooperatives, and so I put his email in the chat.
Alan, if you would, Alan has put a message in there talking about that. Alan, I don't want to put you on the spot. Would you like to comment on that? It sounds like it, as Alan's saying, it's an issue on CoBank's radar, but apparently, as of yet, they've the cooperatives have met their margin requirements in general. But it'll take good management at each local unit to make sure they don't get behind.
I think I have audio, but yeah, that's a pretty big issue right now for CoBank, who provides a lot of funding for cooperatives. The information we got is certainly that is an issue that CoBank is thinking through. And so far they've stood behind all the margin requirements and are providing the finance, but certainly it is an issue on CoBank's radar. But so far so good in terms of being able to provide that financing to help with margin issues.
As I recall, in the past, if anybody is seasoned enough to remember the hedge to arrive crisis, et cetera, a fair amount of what had gone on in that had to do with hedge account margins growing to a degree that the lending sources to the local elevators were getting hesitant, that they were wondering about where things were going. And so there is a history of that happening. It's good to hear that we haven't seen that occurring at this time yet.
Anything else, folks? We've got time if you want to ask something. While we're waiting, I'll just mention the meeting on Wednesday, and I'll when I send out an email with the evaluation and the link for the video later this afternoon for this, I'll also include the registration link for that on Wednesday.
And for my part, I'll be supporting Antonina, excuse me, going first, and I'll follow up with some of the world supply demand balance issues that we just briefly touched on here, and also we'll try to aim to give an update on how the presence or lack thereof of Ukraine grains, particularly for wheat, for corn, and for sunflowers, are liable to affect the grain markets, and they're no small impact.
Dan, you had one more pop in.
David Reinbold asks, what is your outlook for demand for ethanol, feed, and exports for 2022-23 corn? In the handout, I don't have it up here at the moment, but it looks like, but for ethanol, of course, it's a margin game. Our ethanol prices holding up decently. let me pull that up. The most recent trends in ethanol prices have they've been level, and corn prices going higher. So that'll crunch the margins for sure. That's kind of a hornet's nest of issues. If everything's left unchanged, we'd say, well, gosh, if the economy is going well and we're using lots of gasoline, ethanol participate in that. We have heard a lot of discussion about E15 coming into play, all that much more, other issues in the ethanol industry. So generally going positive, but as long as corn prices are running up at a higher rate than ethanol, that's going to tighten margins. And for feed and exports, what I'd heard Mark talk about in terms of cow herds being sold off is worrisome, but generally the USDA is pretty optimistic, and I think they projected 5.65 billion bushels of corn usage and raised that number. So at least from their macro perspective, they're seeing feed demand holding up. Exports for 2022-23 corn, I think that we're heading into a very tight supply demand situation. Our quantity might not hold up as much as the price we get for it, but it seems that we'll do pretty decently. We are hearing reports that the Brazilian corn crop, their second crop, is off to a decent start. I would tend to think, in my own thoughts on that, David, is that that we're kind of conditional. If they have a good crop, we'll still have okay exports. If they have a crop failure of some type, La Nina comes in and catches a good part of that, then all that much more, we'll see strong demand heading off into the 2022-23 marketing year. So it's kind of a 6-month issue, 6-month focus on South America, 6 months focus on us. And if their production falters in any way, then it's just that much more demand coming to the U.S. There's a question: are there protections in place for people dealing with commodity brokers? Concern of the volatility that we've seen in other commodity markets, such as nickel, could spill into our future markets. Mark Nelson, do you have a comment on that? Most of the time, I think our ag brokers that we're dealing with, they're pretty well known amongst clientele, and if they step out of line, their reputation precedes them elsewhere generally. And so but still, if someone were to carry out fraudulent actions, there's legal recourse against it. And I think in agriculture, we are not shy about legal recourse if needed. So I'm not just trying to walk around that, but so I guess you need to work with a trustworthy broker. Mark?
Yeah, I don't have a whole lot to add to that beyond, obviously we have the Commodity Futures Trading Commission, and then obviously the markets themselves police and are constantly examining trades to see if there's any things going on from that standpoint. I don't know if maybe I'm fully understanding where you're coming with the question, but but yeah, both CFTC is following that and chasing that, and then also the exchanges themselves police trades to make sure that things are all on the up and up. Obviously, people have some recourse if you feel like you've been wronged as an individual.
And Mark, my understanding in that nickel market is that the market itself, it's the London Exchange, they actually canceled some trades that were made at high prices to protect some of the nickel mining companies. So yeah, that's where it's not just the brokers, but in that case, I think the market may be broke.
The exchange. Interesting. I think I need to be more informed before I can on that particular situation. Thank you, Rich. There's a question from Joseph Kramer. How many beans will be needed in 2 years because of the biodiesel initiative? Well, you asked me a straightforward question. I'm going to give you a set of bounded answers. So here's the first bounded answer. I don't know exactly, but on the one hand, we're building plants. You see a lot of proactiveness on the part of major companies, ADM, others, building plants to meet that demand. So the industrial base is there. We hear of this. We've heard of some of that in Missouri, Kansas. We've certainly heard of it in the Dakotas. We've heard it with canola to the north also. So that's there. And you look at the supply demand balance sheets for soybean oil, biofuel, trending higher for sure. But I would note that when the Ukraine situation hit, that one of the adjustments that the USDA made in the soybean oil supply demand balance sheet was to lower the amount. I think it's about 200 or 300 million bushels, million pounds, pardon me, of biofuel production, and they added 200 million pounds onto soybean oil exports. So the trend is there, but what's happened in the Ukraine with disruption of the sunflower oil industry, and with that being so important for the world market, right now soybean oil is displacing. Soybean biofuel use is being displaced by food use in the soybean oil market. Interesting to see. Terry Riley asked, will we eventually plant for domestic soybeans, export less, corn residual, in my opinion, for the long term? Well, I don't know for sure, but it seems to me that just as in the corn market, when prior to ethanol, we were much more export dependent. Now we've built up a strong domestic demand base for U.S. ethanol. And if anything, on the as long as it meets EPA requirements and is acceptable, you're moving towards more domestic use of U.S. soybeans as well. If you're an old free trader like me that wants to would like to make sure that there's adequate flow of U.S. and South American soybeans to meet developing countries' needs and elsewhere, then what you're looking at is as these major producing countries have more and more domestic usage. I'm not saying you're crowding out those other export uses, but you're going to raise the price, you're going to raise the stakes on it. So do we get there eventually? I don't think so. It'll be a competitive process, but to the degree that we see the development of fuel usage, then it's a competitor on exports and affects the landscape of where U.S. grains and oilseeds go. Well, we sure invite you folks back on Wednesday, and like I say, I'm really looking forward to Antonia's perspectives on this. It'd be really worthwhile, and I really am looking forward to hearing about the production side on the one hand and the logistics. I'm concerned about the logistics. We may be able to produce it, but can we move it? That'll be a big challenge.
Well, thanks, Dan, and thanks to everyone that got on. And Ron, we'll see you Wednesday along with some of the others here. Appreciate you being on for today. So thanks, Mark. Appreciate your time too.
Thanks, everybody.
Thank you all.